Great. Thank you, Alicia, and thank you to the other organizers. It's a pleasure to be here. And as Alicia said, this paper really just came out 2 weeks ago, so she got it hot off the press. And I'm really happy to be here. I've only presented it once, and I got a lot of good feedback and input, so I'm looking forward to that again today. As Sharon was saying, this is a very, very new field, and I think there are a lot of questions for all of us to think about. And certainly, I already have a lot of ideas from presenting earlier in the week. As I mentioned when I introduced myself, I work at Bruegel, this think tank in Brussels, but I also work at the OECD. My work at OECD has been focused on entrepreneurial finance, mostly. My background's in finance, and I wrote a book on angel investment that came out in 2001, and done a lot of work on seed and early stage finance. It was a paper that came out last year. And I'm currently working on another new area, social impact investment at the OECD. I have a paper that came out in July, and we're doing a big project for the G8. The paper will come out in November if we get it into the system later today. That's why I'm online with my research assistant. Anyway, so crowdfunding. So let me just get the slides going. And sorry, I know these are really hard to read. At Bruegel, we have this really funny font and format that we have to use, and it's illegible. So I apologize for that. I'm forced to use this. Anyway, as we already know, and we heard more this morning, crowdfunding is getting increased attention around the world, and particularly for its potential to fund startups. And of course, we know that startups are really important for economic growth and job creation, so policymakers are getting really excited about crowdfunding, and they think it's the new, the new VC, the new angel investment. And recently in Europe, those of you that follow European politics and the European Commission, we have a new Commission President, Jean-Claude Juncker, and he came out this summer with a speech about Europe's capital markets and the need for more non-banking financial intermediation. And so, of course, all of these non-banking tools are getting a lot of extra focus at the moment. So actually, the timing of this paper was really good. We didn't plan that. Anyway, so what we try to do in this paper, we had done an event back in May, and we wrote a blog at that time as well, trying to help clarify. There's a lot of confusion about crowdfunding. People think crowdfunding is outside of this room, a lot of people think it's just one thing, and they don't understand the different models and how different they are and the different motivations and all of that. So we wrote a small blog on that came out in May or June, I don't remember. But then this paper, which really focuses on equity crowdfunding, because I really wanted to address this issue of people thinking that this is the next best VC angel investment, especially being someone who's done a lot of work in that area. So you all know this, I don't need to go through this, the different forms of crowdfunding, the donation-based, where people don't expect anything in return, they just want to give to a good cause. This is great. Crowdfunding makes it easier for people to connect to these good causes and give money. It's great. Reward-based as well. For all the reasons that Sharon mentioned before and that we were discussing, reward-based, which is a big category, also is a very good, very interesting model. Of course, there are issues there in terms of whether you're ever going to get that thing. We'll check in later to see if he gets his product by December.
Yep.
You let us know.
I will. That's right.
But anyway, and of course, the problem there is if you don't get that film or that album or whatever, there's nothing you can do. I mean, you have so little power as a tiny investor. But still, there's a very clear expectation. You know you may not get that, but you don't mind, right? You don't care if you don't get it, because you feel good that you were part of something. Lending-based, we didn't look at that so much, so we had a really good discussion with Brian last night about this. He's done, I understand, a lot of work on this. My colleagues were asking me when I presented earlier in the week if much of this crowd lending was for startups, and you were saying that no, it's more for individuals and for a variety of also personal, not only business things. So anyway, I won't get into that. So we're focused here in this paper on equity crowdfunding, and of course, with equity crowdfunding, these investors expect or hope to have some sort of return. Of course, they feel good that they're anyone who knows angel and VC knows that you can't, the chance of getting something back is not 100%, that's for sure. So Sharon already shared some numbers from the industry, and this is from Mass Solution. We looked at the growth in the industry from 2009 to 2013. There's that $5.1 billion figure. Of course, this is for all crowdfunding together. And again, this is where people get these wrong perceptions about crowdfunding. 60% of the market is North America, but that's mostly the US. And 36% is Europe. So Europe is very, very involved in this market. And equity crowdfunding, which gets a lot of hype, is the smallest. I mean, you can see in 2013, it was only 4% of the market. So, and if you look at the growth rates over there, you can see most of the growth has been in reward crowdfunding. Tremendous growth. And, I think that in many cases, people mix this idea of reward and equity. And they think, oh, well, I've invested in a startup. But they haven't really. They've sort of prepaid for something that they may or may not ever see, but it's very different than actually expecting financial return back. So anyway, so however, in Europe, I don't know, maybe I'm jumping ahead here. Okay. In Europe, equity crowdfunding is the largest market at the moment. Sharon mentioned that even with the Jobs Act, it hasn't been enacted yet, so you can't equity crowdfund in the US unless you're an accredited investor, then it's not really crowdfunding. And in Europe, through exemptions and regulations in different countries, people are able to do crowdfunding in certain countries. Anyway, I'll talk about that more later. I'm jumping ahead. So we all know that the platforms play a very important role in crowdfunding, and we also know that the role that crowdfunding platforms play is very, very different. And this is really important, and I was going to add this to Sharon's list, but it was already on there for future research. But really looking at the different crowdfunding models, because I think the whole success of crowdfunding will be made or broken by the platforms themselves, and also how the platforms are, what kind of rules and regulations the platforms have to follow to make sure that they're doing what they said they would do. Anyway, I don't need to go through this because I think all of you already are familiar with this, but in terms of the little print on the bottom, which is hard to read, platforms, I think you probably already know this, they typically charge some flat fee for companies that want to list on the platform, but then they also charge usually 5 to 10% of the money raised, and that's their business model. Some platforms also charge a fixed fee or a percent of the amount raised or profits from investors. And actually, that model is interesting because otherwise it gets to be incentives of the platform. Does the platform have an incentive just to get more people to list? In which case they don't really care. Their bar might be a little bit lower. Let's get everybody on because we get more money for ourselves. Versus you get paid actually if the organization actually does well. So I think these are some interesting things to look into in more detail. Again, I apologize. I know this is impossible to read, but it's in the paper on page, maybe that's easier to look at. Thank you, page 6. And this is a smaller version of what's in there. But basically in the book, the angel investment book that I wrote a couple years ago, I had a table that compared angel investors and VCs, trying to show the different characteristics of these different types of investors. And what we did in this paper was add equity crowdfunders in there to show, again, how all of these three types of investors are very different. So first, it starts with the background of these people. So we know that angel investors are usually, hopefully, experienced entrepreneurs or experienced business people. VCs, they usually have a finance consulting background, or maybe they're from industry, but they're trained in how to do venture capital investing, whereas equity crowdfunders are just average people that they're unsophisticated investors. Typically, they don't have any sort of training, experience, or background. And investing in startups is a very particular thing. You actually need to know what you're doing. It's not simple. You don't just look at a fancy website and say, wow, that's a great company, I'm going to invest. And I remember when I first presented this draft of the angel report at the OECD committee, they said, well, why do you talk about the training of angel investors? I thought you said they're sophisticated investors, so they should know, what they're doing. And, they may be entrepreneurs or business people, but that doesn't mean they know how to invest in startups. So actually, the mentoring and training of both VCs and angels is really, really important. And the other thing is actually meeting the team. It's not just about the business model. I used to work in venture capital, so it's not just about the business model. Certainly, it's not about the website. They have this sort of fancy website, and that's great. But it's not even just about the business model. It's really about the people. And ideas are a dime a dozen, but the team, can they really implement? Can they really make this stuff happen? That's the key. And you never get a chance through a platform to meet the team. So, again, these are some differences. Other things that I have here, so the amounts and the stage in which people are investing. Obviously, crowdfunding and angel investing is a bit closer there. VC is in a whole different league, so I think we can take that off the table. In terms of geography, angel investors tend to invest locally. VCs tend to invest locally as well, or nationally, although obviously they do cross-border investments too, but usually with a local partner. Whereas equity crowdfunders can invest in anything. They're just investing through the platform. And again, this has implications for due diligence, which we'll talk about later, and also for monitoring of the investment. Anyway, I'm not going to go through all the details here. I already talked about the motivation that people might have. VCs, at the end of the day, they're looking to make money. When I joined VC, I was very optimistic. I thought this is all about economic growth, job creation. And I realized to be a good VC, you've got to be a great negotiator. You've got to get a good deal out of the entrepreneur on the way in and a good deal on the way out. And those are the firms that do well. That's the business model. Angel investors, they're investing not only because they hope to have a financial return, but they also want to help other entrepreneurs like them. But crowdfunders, they're probably doing it more to be part of something than to have any financial return. At least I hope so, because they're probably not going to ever see any return. But as long as they know that, and this is part of the problem, the expectations that these crowdfunders might have, and the amount that they're investing. So what we did in the paper, we went through the different stages of the investment process, and we looked at the differences between crowdfunding, angel investment, and venture capital. Obviously, the first big issue is due diligence. Due diligence is expensive, it's time-consuming, and it needs to be done well. There are a lot of papers out there that show the obvious, which is the more due diligence you do, the better chance you have of having better returns. I mean, that seems really obvious, but people seem to forget that in the excitement of investing in a startup. And VCs take this very seriously. Angel investors, depending on whether they're investing by themselves or through a group, do different levels of due diligence, and they pay the price in terms of returns for that. And for crowdfunders, they don't have a chance really to do any due diligence, so they're at the mercy of the crowdfunding platform and whatever level of due diligence the crowdfunding platform does. And again, this really varies. And I think the crowd investor doesn't always understand how important that is, and they may not understand the differences between platforms when they're choosing which platform perhaps to invest through. They might not understand how important that is. The other thing, entrepreneurs and the crowd, they tend to be over-optimistic. There are also a number of papers on this in terms of what the actual returns are going to be. And again, this is a cause for concern if they're expecting to get some financial returns when probably they won't. In terms of the investment stage, a lot of these deals, it's the incentives that are critical. I don't know if you know Bill Solomon at Harvard Business School. He has a famous book, or paper that came out a number of years ago, and he talks about the context, the people, and the deal being the three key things in venture capital investments. And so how the deal is structured, you can have the right context, it's the right opportunity, you can have the right people. I already talked about how important people are. But if you can't structure the right deal so that all the parties have the right incentive to really grow this company, then the whole thing's going to fall apart. So VCs know how to structure these contracts. Angel investors to some degree, especially if they're investing through groups. But these crowdfunding platforms, they have these standardized contracts. So, again, this is another difference. The other thing, and Sharon already mentioned this, venture capitalists invest in a portfolio of companies because the majority of these companies don't make it. So usually one or two, hopefully, in your portfolio are hits, and some are complete disasters, and then the rest might sort of bump along. And that's the model. Angel investors, depending on how much money they have and whether they invest in groups or not, they try to have a portfolio approach, but not all can afford to. But crowdfunders don't. They usually make one investment. And I was interested in your data. We also saw some data from Cedars, but I was interested that it's broader than just one platform. That most of them just invest once, and it's probably through friends or family or something. So again, they don't have diversified risk. They're 100% risk in this,
Well, I would say, one of the key innovations that's coming up now are these syndicates where, like for example, Brad Feld just put together this, founders group syndicate where you invest one amount of money and then it's invested over 15 deals. There are innovations in the crowdfunding space where they are trying to get out of this portfolio and mitigating risk by having to diversify the investment portfolio.
Yeah, and there are a lot of innovations in the space, people trying to get around some of these issues, and we talked about some of that in the paper. Thank you.
And then the long due diligence as well. Some of the groups like AngelList somewhat, and then like Circle Up, due diligence documents are uploaded into a space where if you are an investor and you're thinking about this deal, you not only have all of their financials and there's pitch deck and so forth, and there's also office hours and so forth for you to actually talk to these investors. So some people choose just to let the platform curate deals and trust that, and others are actually doing additional due diligence on these platforms.
And the thing that's so interesting about that too, right? So in the U.S., that's a way that someone like Brad Feld, who's an accredited investor, is opening this equity crowdfunding to the non-accredited investors because essentially he serves as the aggregator.
No, you still have to be a accredited investor to invest in that.
Oh, you do?
Yeah.
Still.
Oh, I thought
Until
it
the
was.
jobs act comes through.
I thought.
That's the thing.
I thought he was doing an LP.
No. Just to invest in these funds, you still have to be an accredited investor. But
he's doing the due diligence.
And you could do additional if you want, but I would say I trust Brad here.
So these are still sophisticated investors that are involved in all of this. So I would say it's not crowdfunding, but it's a model for what crowdfunding can do once it's allowed.
Well, I think it is crowdfunding because they raised $4 million in this fund, but with several hundred investors each investing $10,000 to $20,000.
Yeah, these are sophisticated. It's not the crowd.
Well, it's a crowd of accredited investors.
Well, all right, we'll debate it.
Very large syndicate.
Exactly.
Okay.
Yeah, there's also this whole debate about, the wisdom of the crowd. That also you can say, crowds are stupid, and the herding behavior of crowds as well. So, these are, again, this is a different ballgame here, but the real crowd, I have my doubts in terms of, how well they can make some of these decisions. But there are platforms, for example, in Belgium, there's a platform, My Microinvest, where crowdfunders, where equity crowdfunding is allowed, can co-invest with angel investors. So angel investors are sort of taking the lead in doing due diligence. So I think models like this that are evolving are going to be the way to go in some of these things. Plan for post-investment, the monitoring costs. I already talked about the fact that many crowd investors are investing in a distance, and anyway, they don't know how to monitor their investments. The platforms some platforms supposedly help do that. Again, they sort of make this investment, and the other thing they may not realize is that these investments typically are 5 to 10 years. So they're not going to hear anything, and they're not going to understand why they haven't gotten a check in the mail. So, and they're also liquid, so they can't do anything. They can't sell this investment to somebody else. Now, if they made a $25 investment, that's fine. But if they made $100,000, which they can in some countries, or even more than that, if they can in other countries, they're going to want to know. So, these are just some issues to think about as equity crowdfunding, the floodgates start to open up further in different countries. And also, we know that there are very few IPOs and mergers and acquisitions. I have data for, obviously there's some high-profile IPOs at the moment, and the window's opening up a bit, but if you look at 2007 to 2012 in Europe, IPOs were 7% of all exits including bad exits. We only talk about the good exits, but the majority of exits are bad exits, which we won't talk further about. It went from 7% to 5% over those, 9% to 5% over those 5 years during the crisis. And M&A went from 17% to 12%. So the chance of having an exit, a good exit on any investment, and this was just VC, but these professional investors, the chance of having a good exit for their company is not so high. So anyway, these are all things to keep into consideration as we're getting all excited about equity crowdfunding. Here, I already mentioned, and Sharon mentioned, Jobs Act will make it possible for people, but it's still not in place, and so only accredited investors currently can invest in the U.S. through some of these platforms that do exist, and the different models that are coming into the pipeline. That we'll see what happens when and if it finally opens up. I don't think it's a matter of if, right? I think it's just when. Yeah, it sounds like it's going to go through. But in Europe, because of these exemptions, people have found ways around it, which is also a little bit scary because, then in one country you can do something, in another country you can't. It's not illegal, but it's not really legal. And so it's a very uncertain environment in Europe. So basically what we point out in the paper is that we do think that crowdfunding can be an additional way to provide some seed and early stage finance to new ventures, but policymakers need to be very careful. First of all, they need to understand the differences between the different types of crowdfunding, and they have to understand how different crowdfunding is from angel and VC, and they have to understand particularly what all the issues of investor protection. And that's what the whole debate is about anyway. But in Europe, I think they're a bit behind the ball. Things sort of started to pop up around Europe, and policymakers are frantically trying to figure out what is this and what do we do about it. And it sounds like it's a good thing. Everyone's so excited about crowdfunding. So, of course, we know there are a lot of risks, possible fraudulent activities, and we know that the role of platforms is really important. And so, what people have been trying to do is figure out where to put the threshold in terms of the amounts that investors can invest, and also the role that platforms play is really important, and how should these platforms be overseen, as I mentioned earlier, to make sure that they're doing what they said they would do, because their incentives might be just to get a lot of these things online and sell a lot of swampland in Florida to a lot of unsuspecting people in the crowd. So finally, we suggest that because it's a highly deregulated market in Europe and there's very little protection for these investors, that at least, right now it's very ad hoc, that at least there should be some harmonization of policies. So it's not to try to block it, but at least to try to have some consistency across Europe in terms of the minimum, in terms of what the minimum sort of bar or quality for the platform or minimum amounts of investor protection to make sure that in certain countries people aren't at more risk than in others, and also to open up more of a pan-European crowdfunding market. We also talked about the fact, and this came up in the event that we had, there are a lot of other regulations that also play into crowdfunding regulations in different countries as well, corporate law, but also other regulations as well that have an impact. So it's much more complicated than it seems at the surface. Anyway, so that's it. If you want more information, you can look. We have some notes from the event that we held. We have a little video on the website, and we have the blog that we wrote earlier. But I'm happy to take questions and also any ideas you have of other things that moving forward. Thank you.
Great, so now we have some time for Q&A. So Sharon, you can come back down and I'll let you facilitate the discussion. You can start. And I can put the Berkeley URL for the data, and if there's a place, you'll see right on the top, it says registers, just create an account, and then you can access it.
So I'm going to start out with a question for Karen.
That's cheating.
Well, one thing that you hear a lot of VCs in the US talk about is how it's going to work if they want to invest in a company that's got a cap table with 1,000 investors.
Exactly.
And I'm wondering
Right.
what the experience has been in Europe. I mean, does it make it more difficult to bring a professional investor in if you have all these small equity holders?
Absolutely. It's a nightmare. I mean, many VCs don't even want to come in when there are a bunch of angel investors involved.
Right.
So this is another issue. When a company chooses to get equity crowdfunding, then they might get angels coming in later. This can be really hard to make VC. So the potential of the company to grow and scale and to actually have an exit is very limited.
But what a lot of crowdfunding platforms are doing is doing an LLC, which is a single investment vehicle where all the investors are in the LLC and the LLC is the one on the cap table as one entity. Otherwise, it would be.
And that's done at inception or later?
Well, it's done for the investment from the crowdfunding platform.
I see.
I mean, again, it depends on the,
A lot of times,
Yeah.
I mean, like, there's some where Circle Up's raising, say, $500,000 and they have 4 or 5 investors, probably all 5 would be on the cap table. But for some, for like WeFunder and AngelList and a lot of like Brad Feld syndicates, each one is an individual, each investment is an LLC, and then all the investors are aggregated into that LLC, and it's one line on the cap table.
And something that my colleagues asked me is, what happens if a platform goes belly up, or if a company doesn't make it? I mean, what legal recourse do these private investors have? They don't have any.
That's why the LLCs are formed, so that the platform goes belly up. The LLC has the investment in the platform and not, in the company and not the platform.
So, quick question about the platforms. Do we, from anyone's, I guess, expertise in this area, do we see a firm listing on several different platforms, or even several different platforms at the same time? So, I mean, each one might have its own, like Kiva might have a very social message, and so maybe I craft, my particular message to that particular area or whatever. But it seems to me that once the kind of investment in creating a profile for a platform is done, then replicating that is just more access to more capital as opposed to putting all my eggs in one platform basket, so to speak.
So I can answer that anecdotally. I don't have any data to kind of give you numbers on that. But since it's mainly driven by whoever's putting the campaign out there, I don't really see a lot of value in listing across. You're saying like one loan? Are you saying?
So one firm being on several different platforms.
Right.
So seeking funding for.
But if they're the same basic type of platform, like lending.
Right.
If you think about the donation per pre-orders model, like the Kickstarter model, which is, I think, what most people kind of think about in their mind, at least in the US. I don't know that there's much value in listing across platforms because it's mainly who are you going to drive to the platform in the first place. So whether you drive them to Indiegogo or Kickstarter, and then you're going to be, I don't know that there's much value. It's just extra bureaucratic time on your part.
Like also, and each of those platforms do take a fee, and so I think what the more common thing you see is, for example, on AngelList or WeFunder or Circle Up, you've got a lot of people raising online on a platform, and then you see a lot of the raises listed in AngelList is raising offline. But the other thing you see, which becomes really confusing, is you'll see these crowdfunding platforms like WeFunder or others saying, oh, this company raised, $3 million. Well, they might have raised $3 million, but 2.7 of it was offline, and that platform was only responsible for, a small part of that. And so that is one thing researchers need to be very careful about is the
claims.
It's cleaning the data, making sure that and encouraging transparency among these platforms. That's one of the things we're pushing for is, you can't list the $3 million raise, you need to list the $300,000 raise.
Well, I think about it a little bit. If I'm marketing myself, for example, so I could have, forgive the analogy, but a MySpace page and a Facebook page and a LinkedIn page. Now, some would say that, the MySpace and the Facebook are basically, or MySpace and the Facebook are basically the same kind, and maybe people are on both. But what I what I put out there on my Facebook page is a little different than what I put out on my LinkedIn page. And so maybe it's, I'm tailoring the message a little bit to the market. And I don't know if there's been any research on that or because that's really
I
tough.
mean, I open that up for anyone else. I haven't seen anything that looks across platforms. I mean, it's an interesting question. I mean, I think what you're going to see in the platform space, and I'd be interested in your perspective on this too, is there's going to be a few platforms, there's going to be a shakeout, and there's going to be a few that survive. So there's going to be a few kind of general, kind of the Amazons of the space, like the Kickstarter and the Indiegogo. And then you'll have some platforms that are very specialized, so there's some that raise money for medical expenses, for example, teachers who want supplies for their classroom. So you'll have some specialty ones, but I think you're going to see a shakeout. I think you're going to have a few kind of Amazons and then a few niche players, but I don't think having 800 plus platforms is really sustainable. Because the thing is, you want to reach an audience. If it's some platform that no one's ever heard of, you have to be, you can drive your friends and family there, but you're not going to get the casual person
just to go
there.
Sure. Yeah.
Karen, or both of you.
Karen and Sharon.
If you invest and you have this equity and somebody comes along and invests, and so they get some equity, what regulatory bodies overseeing that? And afterward, I guess they get something. Who's overseeing to make sure they're getting what they're supposed to, the property rights allocation?
Yeah, this is the thing. It should be then the platforms that have to play this role, but then who's overseeing the platforms? And what happens if the platform goes belly up or stops operating after 3 years? These investments were 5 to 10 years or longer. So, and all of this is really new. So one of the things that we'd like to do is to actually try to look at some of these platforms in Europe and try to look at some of the data from these equity investment platforms and see what's really happening and try to see if there's certain sort of milestones to look at to see how things are going. Because right now there's absolutely no evidence and there are a lot of open questions in terms of what might happen down the road, especially with the regulations being so unclear.
So the platforms have some responsibility for monitoring their ongoing profitability and ensuring?
It depends on the platforms, but I believe that many of these equity crowdfunding platforms do. So, and one thing that we didn't do in this paper, but we might do in follow-up, is to really look at these different platforms and compare the models and try to get some of the data from them and see what the results are to date. And there are a number of researchers in Europe that are doing some work. Of course, now the names are slipping my mind, but I can send them to you guys. They could be included in the next round. But we really have to look and see the evidence of these things, and also see what the success rates have been. I was asking people last night about the success rates of the donation and particularly the reward-based. How many?
You said the mid-40s.
Mid-40s.
Like most of them, of the different, I don't know the stats on the equity ones, but it's between 40 and 50, the different kinds of platforms.
Yeah. And the thing is, we don't know for the equity ones because they're new and there haven't yet. I mean, there have been a couple of successes. There have been a couple of failures. There haven't been any big blow-ups yet, which I find surprising.
And when I say success, I just mean campaign success. I don't mean,
Even just done the study of there's a direct inverse correlation of the amount oversubscription and how timely they are in their payment of their reward.
Which makes perfect sense, right? I mean, I don't know if any of you saw the CNN clip with the coolest cooler guy, but I mean, this guy is not prepared to scale up to 13 million. He was trying to raise like $50,000 or $60,000, and so of course there's going to be a huge delay. Now he's got to manufacture all these units, and he can't use anything that he's lined up because the order is way long. And like any entrepreneur has that problem, and to go, and have that demand on you is, who can do, like anyone that can do that, you should invest in them tomorrow, right? I mean,
They probably will with their extra millions to do that.
Yeah, so you have to make them and ship them.
Yeah. Well, that particular model is a pre-order model, and many times they are. Like the cool product, like the heavy launch, it's a pre-order. You want to be the first one to get it.
So and also for the equity crowdfunding crowdfunding, I think the interesting thing is that there's a few models. There's like the WeFunder model that puts up anything and everything, and then they kind of curate some of the highlights that they want to push. But then like Circle Up, for example, only puts 2% of the applicants on their platform, so they have a much higher success rate, but yet they have very strict requirements of what they're looking for to put on the platform in the beginning. So I think just like the heterogeneity among platforms, there's also going to be heterogeneity among the types of equity platforms, and if we don't keep those things into account, we're going to be comparing apples and oranges.
Yes,
So it's going to be really important.
And I think back to Scott's point, I think that curation feature
Just-
might drive which platforms end up being successful long term, because you're busy, you don't want to look through a bunch of junk. If you know you can go to this platform and they've already done some due diligence, you're going to spend your time there as opposed to something
That's how
that's
the shakeout is going to
Yeah.
happen. Yeah.
Yeah, someone was telling me about something, sorry, I don't remember who it was, that on Kickstarter, the success rate is 60%, and on Indiegogo it's 40%. I don't remember who it was.
Yeah, Indiegogo is much less.
Yeah.
Just
They
because they
don't
put
do it.
everything out there.
Yeah. Did you have a question or a comment?
Yeah, at Alicia's point, I think in the long run, maybe these equity crowdfunding platforms could just be like mutual funds where their success and is publicly available and all the investors can see and decide where to go.
Yeah.
Like I was working with Sinbad in Netherlands, and they recently acquired a valuation company called Equidam, and because they want to do a good job with the due diligence and make sure that the valuation is correct before they put any project out there, precisely for the reason that they want their investors to get their money's worth.
Right. Well, and it's interesting, because if you look at the lending platforms, there's a credit rating, so maybe there ends up being some sort of risk rating that goes along with some of these equity.
Some of it could happen even with the syndicates, like you have a syndicate manager and they could put what's their return over time, so that, again, people could see and decide which manager to invest in.
Although no one wants to disclose that, because the success rates are so low, right? I mean, this is a classic problem with research on venture capitalists. Like, no one wants to report their rates of return, because generally they're really low, and they still need to raise a fund. So I think the transparency element is going to be challenging to get at.
To follow up on Sunil's comment, I'm wondering for these for-profit kind of crowdfunding undertakings, how much of the dynamics we're seeing now are kind of transitory, in that the original spirit of crowdfunding was this kind of individual to individual, looking at this, but in reality it seems like this extreme diversification is more logical, and I'm not sure the exact stats on Lending Club, but my understanding is it's kind of moved away from this. People are just kind of investing in it, $10,000 and it's spread across all these individuals, but there's not kind of a motive to actually spend time investigating each one. And does that make sense for the crowd to do that without some kind of special expertise? The dynamics, what we're seeing kind of now might just be one step in an evolution.
I think you raise a great point, but and I think it does get back to understanding the motives of the investors in the first place. So you do have some that want a financial return, and I think you're going to see different dynamics and different ways that you have to reach out to attract those investors. And then, I'm so struck by the differences between what you see on the Kiva platform versus Prosper. The Kiva ones, like this, your tenacity, your success in the past is negatively related to campaign success. That makes no sense unless you factor in the fact that I'm contributing, and Tom Allison has done some of this work at DTP. He classifies it as a warm glow. So I'm investing in you because I think no one is going to invest in you, and your only chance of making it is if I do it. But that's a very different dynamic, and understanding those differences, and from the perspective of the person that's putting the campaign out there, who are you trying to reach, and how you do that is going to be fundamentally different. Do I talk about my success as an early entrepreneur, or do I talk about the fact that a hurricane came through my town, and it's a very different kind of messaging.
So thanks for the update on the literature review. It was super helpful, and it leads to my sort of speculative question for you, which is when you organized a crowdfunding conference in Berkeley last July, we had talked a little bit about
In Boulder.
Alicia
worked on the Berkeley
In
one.
Boulder.
Alicia, the credit.
In beautiful Boulder, which was absolutely wonderful. You all
were speculating there about the different theoretical, not treating crowdfunding as a phenomenological entity which you study, but as a mechanism or a context in which we can begin to think about pushing the boundary of theory or theory updates. And so obviously capital market theory is an interesting place to think about this stuff, so we're talking this. And at the time, you were speculating that perhaps OT theory, and because now you have this emergence of a new organizational form, you have the opportunity to examine populations, and it's very rare that we get a chance to see the kind of the birth and evolution of the population. That's really great. And we speculated in the case of strategy that because we now have this interesting, we actually have this clear performance variable. So these amazing opportunities to use this context to explore theory, development, and strategy, OT theory, OT, and finance. So given that background, do you see any advances there and any other new opportunities there? New opportunities for theory that we talked about last year, and then like what's happening in these spaces theoretically. I don't really sort of marginally interested in crowdfunding as a object. I'm interested in advanced my understanding.
Well, I mean, I think there's still lots of room for opportunity because, you know, if you think about the timeline, I mean, you know as well as I do, like you come up with an idea in 2013, it's not in press now, right? You know, so I think there's a lot of work that's still very early stage. But when I think about some of the dynamics, for example, with where social influence plays out and doesn't play out, you know, I mean, that I think is really interesting. And some of that herding effect, which is the opposite of what you would expect. You know, I think that really speaks to, you know, understanding some of these things about social exchange theory, networks, you know, the strength of different ties, how you mobilize those ties, what some of the implications of that are, what some of the implications of that are, and Yonkin and Kashkuli, where's Peter? It's supposed to be here. You know, but he's looking at some of the dynamics around, like, is there a community around, you know, within Kickstarter, for example, that affects your ability to raise funds in the future? So these notions of community, I think, are interesting. You know, so to me, I think a lot of the things that we talked about still deserve attention, and I think then there's some more when you look at some of the stuff about social influence that's come out in the last, you know, 6 to 12 months. That opens up some questions that, you know, you look at some of those results and you go, oh, that's interesting, I wouldn't have expected that. So I think how social influence plays out and when, I think there's some fruitful opportunities to look at that also.
Thank you.
I just have a comment maybe, or as well a question. Regarding equity crowdfunding, I think always we should take a step back maybe. We always compare equity crowdfunding to angel investment and venture capital. However, I would say, like, why do we not discuss all opportunities which are out there for entrepreneurs to raise money, like government grants, incubators which are raising up like almost every week, one new one in Europe probably, I guess. Competitions, grant competitions from banks, from other institutions. Because when you ask some of the entrepreneurs, and I did some interviews in Germany and asked entrepreneurs why they go for crowdfunding, and they were actually going for equity crowdfunding. They basically said they just want the money. They don't want any advice, anything else. They just want the money. So maybe a point to consider as well, like maybe get some comments on that, whether you have made some research on incubators, etc., and compared those.
Yeah, and obviously there are a lot of sources of potential money for startups, but we were looking at equity. But some of my colleagues also said, you know, why don't you look more broadly and see why the firms. We didn't look at that, but you're probably right. And in fact, there was a study done on Cedars from the investor side saying, why are you investing through this? And then what is it? Anyway.
I think it's a terrific point, and especially if you look at the size of a lot of these crowdfunding campaigns, they're smaller, and they are more in line with what you would get at a business plan competition, or, you know, some grant proposals and things like that. So I think that's actually really interesting to think about it in terms of those alternatives, which are more in line with the size of the contribution to be able to raise through crowdfunding.
In terms of the European landscape, do you see the emergence of a pan-European equity platform? Because, as we mentioned, regulations are quite different, but smaller crowdfunding platforms are partnering up with each other in different countries. So do you see some kind of consolidation in this space in the coming years?
Yeah, well, at the moment, because of all these different regulations, that's not possible. But I do believe that there'll be consolidation in the European market. There are a lot of new platforms that are being developed, again, in these different niches across Europe with different thresholds and different reporting requirements. But if there is a harmonization of regulation across Europe, then yes, I think there can be, and there will be some consolidation with maybe some pan-European platforms, and I think that would be much better also for the investors and the investees.
And isn't that the goal, really, to come to some systematic agreement on rules and regulations?
Whose goal? I mean, that's what we're sort of recommending to the Commission, that they think about this and that they get on top of it, and that they don't just, sort of, that they can recommend to the countries. They can't dictate to the countries that they put these regulations in place, but they can recommend that countries have, which would enable this.
In the issue of the Jobs Act for non-accredited investors getting through, some states in the United States are just like, forget it, we'll do it our own. So we have a lot of states where it is legal now. Intrastate, I think there's 7 or 8, and another 7 or 8 that are almost done with their rules. But right now, currently, it's legal in 7 or 8 countries. States.
California is not a country.
Texas is. So I think so that's why we see some of the states moving forward on their own legislation and rules to do that. One thing I think there's some great area for research is to look at crowdfunding as one capital, either through debt or through equity, as as firms are trying to decide their capital structure, how they're raising funding, how that affects not only the later firm performance, but also how it affects simultaneous funding from other sources as well as subsequent financing rounds, and where the crowdfunding fits into the capital structure on a longitudinal basis. One thing we really didn't talk about a lot about this morning was debt financing, and with lending clubs impending IPO, we're going to see a proliferation, I think, of crowdfunding platforms in this space. Right now, it's predominantly Prosper and Lending Club, but PayPal and On Deck, Cabbage, all these people are getting into business crowdfunding. Consumer finance through crowdfunding is has a much longer history, but business financing is definitely much more recent, but growing by leaps and bounds at billions of dollars. We're talking, it's a lot bigger right now than equity crowdfunding. So I do think that that's something that we need to be watching for us as we move forward.
And that's the CEO that's going to be on that afternoon panel for the Spanish organization. I think that's where they focus is on sort of that lending.
The lending, exactly. She's CEO of the lending platform. So I'm trying to keep us all on track. So we have a 15-minute coffee break right now, and I encourage you to continue to ask our keynotes additional questions there, and then there will be on the panel this afternoon with our CEO from the crowdfunding platform. But please be back in here ready to start at 11:15. And for those of you doing the paper presentations, if you have not yet given Marta your slides, if you have them, please do so before you go